Welcome back to the morning show here on Arise News. I'm Biola Labi, and with me in studio is
Victoria Pepple.
With at least 30 years cognate experience in banking financial services, Nnamdi Okonkwo is the Chief Executive Managing Director of the top bank in Nigeria, Fidelity Bank. He will be responding to comments made by our guests 2 weeks ago, Mr. Wali Edu and Kamar Bakri, on the capacity of banks to implement the new credit policy guidelines released by the CBN recently. He will also be speaking to us on Fidelity's retail banking strategy and their focus on SMEs. But so quickly, to say thank you and welcome to the show.
Thank you for having me.
So we have quite a number of questions for you on the CBN policy. But before we do that, I just want us to take a quick look at what our guests said 2 weeks ago when they were here about the policy. So let's take a quick look.
I mean, the skepticism has to be founded on something. I struggle to see the basis of it. I mean, like, when I looked at the policy, I thought, you want to start messing around with, CRR? And then I went and looked at other countries' CRRs. I mean, Nigeria 22.5% is on the higher end by far. There are countries like actually don't even have a CRR, so there's the concept of like a cash reserve ratio doesn't even exist. Now, yeah, of course, there are other extremes like Brazil and Turkey that are in the 40%, 30%. I mean, sorry, Brazil and Lebanon that are in the 40-30% range, but at 22.5%. I mean, so typical median CRR is about 2%, 3%, 5%. So, I mean, you can argue that there is something to play with in that. I mean, play is probably an unfortunate choice of words, but, there's a
something to work with.
Exactly, to work with from that point of view. So I don't see that so much as an issue. I mean, the big risks that I see, which I think needs to be, like, addressed full on, actually, are around two things, in my view. On the one is, quite frankly, the bank's internal capacity to actually manage the credit around these two sectors. Typically because they have not been under pressure to lend to them, they've not been under, my own sense, again, partly based on first-hand experience with the banks, is I have a bit of concern about their ability to actually process credit around these two sectors, agriculture and manufacturing. Now,
it is a huge risk, and implementation depends on the capacity that you have. I mean, the risk that Kamal has pointed out, yes, it's a very real one, that you do not actually achieve what you've set out to achieve, that the funds do not actually go in the direction that you want. Naturally, if you are in business and you're paying 20-something% and you see 9%, you're going to gravitate towards it. But at the end of the day, as long as the funds actually, whether it's from some of it is more or less a blend. You will have some loans that are high, and then you go to basically average down your rate of interest by taking on some of the funding that is at a lower rate, as long as it's for agriculture, as long as it's for manufacturing, whether it's existing, whether it's new. At the end of the day, it really doesn't matter as long as you are creating jobs and helping to reduce poverty. So in terms of the capacity, the banks themselves, they have able people. We know we have the banking system that really is full of able people. It attracts good people. The issue for them is that they really do not have the capacity to lend as a whole. They've lost it because they were left with. If you note that before this intervention, loans to the private sector have been falling. So the banks have been retreating from lending to anybody.
So you saw what our guest said 2 weeks ago about the policy, and the first thing they said is they were concerned about, well, Mr. Bachman, to be specific, said he was concerned about the bank's abilities to lend to the sector. What is the first thing you think of when you see that?
Well, it's interesting he said that. Banks, in every situation when it has to do with the economy, the banks will always take a bashing. So I find it interesting that he talked about internal capacity of banks. And is good. You want me to respond to that because
you didn't want that to just go to waste,
no,
right? Okay,
no.
so let's talk about that.
Let's talk about capacity. I think we need to break it down to what we mean by capacity, and I'll take it from maybe 3 perspectives. What do banks do, basically? Financial intermediation. So we take monies from the surplus segments of the economy and pass it on to the deficit segments, which basically means take loans and give deposits. I mean, take deposits and give loans. Now, do we have capacity to do this? Yes, but there are other dimensions. Now, we'll take it from liquidity perspective, which means you are liquid enough to continue in this financial intermediation process. Now, you take it from capital adequacy perspective and test or talk about whether Nigerian banks have capacity in that area. Then we'll finally take it from human capital capacity perspective. Now, if I go to liquidity, what that is simply talking about is your ability to have enough liquid funds to continue to lend. And if you, and that's why this central bank has liquidity ratios for banks. I mean, and then the cash reserve requirement, which we're speaking about today, simply says it's a liquidity management tool. When you think there's excess liquidity in the system, it portends some dangers. For instance, it would make a lot more funds available for people to speculate in the foreign exchange market. People begin to make pent-up demand for foreign exchange, and then that leads to exchange rate devaluation with inflationary implications. So, in terms of liquidity, Nigerian banks are liquid, which is in the first place why this issue of CRR came about. And CRR, cash reserve requirement, simply means that for every ₦1 of deposit that you keep as a bank, the central bank takes 22 and half kobo, so 22.5%. And over time, these funds have built up, and banks are agitating, look, you need to release the funds to us so we carry on our business. And the regulator obviously has been resisting that for a while. Then let's then move over to the federal government's economic growth and recovery plan. Part of it is to make sure that lending in the real sector, especially manufacturing and agri, is improved. And the issue became challenges like interest rate and so on. Now, the central bank has come up with this very creative way to say, look, banks, if you want me to give you back some of your liquidity, I will do so on the condition that you extend long-term loans to manufacturing and agri and the real sector. And for that reason, the loans will go at 9%. So rather than have these funds sterilized in central bank at 0 interest to the banks, it's a stimulus and an encouragement for banks. Now go ahead and lend your funds with me as central bank at 9%. Minimum tenor 7 years, and then you give moratorium of 2 years. So
that's actually the policy. So that's the policy.
That's the policy.
Yes.
So from liquidity perspective, you can see that the banks are liquid enough. Now, if I go to capital adequacy, the Nigerian banking industry, the capital adequacy ratio averages show that we have the capacity. Of course, there might be 1 or 2 players who occasionally might have challenges in that area, but the regulatory framework for regulating banks ensures that at every point in time, the regulator keeps an eye and makes policies that continues to make banks strong enough in terms of capital adequacy ratio. If you recall, before the end of last year, the central bank came out with a rule that if you do not have the required capital adequacy ratio, you cannot pay dividends. So that forces you to retain more earnings, to build up your capital buffers so that you continue to lend safely. Capital adequacy ratio, as you may know, is there are different requirements for different categories of banks. For the tier 1 banks, it's 16%. For any other bank with international banking license, it is 15%. And for banks that have only national banking license, which means they operate in Nigeria alone, that is 10%. So if you look at it, you see that from regulatory framework, from the individual bank's capacity, we have
The liquidity.
the capital adequacy ratio to continue to lend in this area.
So can I ask you a question?
Yes.
Did you get the sense that that was one of the areas in which he felt that there was lack of capacity?
Yeah, because...
I didn't.
No, when
I
you
don't
talked
think-
about
okay.
capacity, that's why I broke capacity down.
No, okay.
I wanted to speak
Okay.
to it from 3 points, and that's why, because people first of all have to understand what banks do. So now, because I mean, so that we put it in perspective. Now we've talked about capital adequacy ratio. The next one I would like to talk about, when you are manager of other people's funds, do you have the human capital capacity to do that? And my answer is yes, in the Nigerian banking industry. I'll tell you why. Most of us that are running banks today started banking in the late 1980s and early 1990s, when merchant banking was the in thing. And merchant banks were the banks who used to lend mainly to manufacturers and the real sector. The traditional banks in those days, especially the big four, if you notice, they were also heavy in agriculture and have the competence, the track record, and the history of lending to those segments. So now each bank has, most banks have grown, especially with the recapitalization of 2004 and the shake-up of about 2008. So the industry is even in a stronger position today to lend. But the reason you would not finance manufacturing businesses before now goes beyond banks' capacity from that perspective of human capital. Risk, not just risk. How about the company's capacity? How about the general macro issues that would hamper a company's ability to complete its asset conversion cycle and repay your loan?
What's making it different now? The fact that this policy is out there and it's a single-digit loan, and we've seen bad loans in the bank, a lot of bad loans previously in the bank. So now it's single-digit to two key sectors of the economy. What's making it different?
Excellent. What's making it different is, imagine somebody who produces, let's say, plastics, and he borrows at 20% and above. He has his own power station. He doesn't have, the transportation of his goods, say from the south to the north, is more expensive because of poor infrastructure. By the time he puts together his cost of doing business, he might just find himself with cost of goods sold to sales ratio of maybe 90%. And this remaining 10% margin is not enough to accommodate other costs. So he will operate at a cost. At a loss. I'll give you an example. And that's why capacity, I'm going beyond. I'll also return to human capital capacity. But because of the question you asked me, I'll give you an example. In the past, I used to be, at some point when I was in corporate banking in the early days, I used to be in charge of plastics. I used to be in charge of flour mills and, and vegetable oil industry. Now, we had a kind of wavy motion in terms of sales of some of those plastic companies. During the rainy season, their sales drop. Then you ask them why, and they'll tell you that people who come from Chad and other neighboring countries that buy their goods, stop coming during rainy season due to poor infrastructure roads. So at that point, if this company produces, you cannot really achieve the same kind of volume of sales. Now, if cost of producing is that high and disposable income of those that buy is lower, then definitely production in the manufacturing sector will drop. So what I'm trying to say is that beyond the bank's capacity, there are bigger macroeconomic challenges that hampers lending to the real sector. Because if you lend money, you expect that money to be returned to you so you can lend to the next person.
So when he says capacity, and I think that one of the things he specifically said is about the bank's abilities to lend to these sectors, So you're saying that no, the banks have experience lending to these sectors because most of us cut our teeth in lending to these sectors in the 80s and in the 90s. But in today's world, with the high interest rate, with 20%, 23%, of course, a lot of these industries have even pulled back themselves in taking loans from banks because they know that they don't have the margins that help them pay for these things. When you now look at what he's saying is, today, do you believe that the banks still have the capability to work in this sector, in the agri and manufacturing, and because of some of the lacks over the years of not working in the sector, they haven't lost that competency?
Actually, what I was saying, in no mistaken terms, is that we're even in a stronger position today to do that. Okay? But because if you lend at the rates that you should lend based on your own cost of funds that you also pay to the cost of the depositors, that it will not be profitable for them. Therefore, so now you have funds available to lend at 9%. I'm simply saying that's at least 11% drop in cost of funds, which makes it easier for those companies. So the issue is not capacity from the banks. And I'm not just talking about history. Most banks today now meet international standards in terms of practices, and I was talking about human capital development. Yes. I've worked in Ghana. I've run a bank in Ghana. I've supervised Liberia and Sierra Leone. In all these countries, at least I can speak, Nigerian banks and have demonstrated that we have the requisite human capital. Most banks today, actually in our days, you do not resume in the bank if you don't go through training school for 3 months. And today, most of us, that's why I talked about people running banks today. Most of the banks now have their training academies where you develop people. So we have the capacity in terms of human resources, in terms of capital adequacy ratio, in terms of liquidity. That's the point.
So I agree that banks have, I'll agree with you because of the academies and the training. Just quickly, as the banks have been able to develop this capacity and these training, why do you think this hasn't cascaded to other parts of in our economy in Nigeria? This type of training and internal building.
Well, somebody also asked me this question. When you come to Nigeria, okay, look at your studio. If this was not a private enterprise, Arise will not making the kind of impact it's making today. So we have, clearly in Nigeria, private sector is leading. People come, we meet international investors. They come here, they put money in our companies because they see that we have the right governance, we have the right human capital to run those businesses, we have international standard governance to run businesses in private sector. How come the private oil companies are also, succeeding like the international?
And that's where I was going to the FDI. Now, we're doing well, we're going to do well with these two sectors. Lending at 9%, meaning the sectors will grow, and automatically the economy will do better. When do you think it's going to get into other sectors? And what are the expectations for FDI, as it would look like an enabling environment for businesses to grow and thrive?
Okay. It's a chain effect. If these manufacturing companies come alive, remember, when Dunlop left Nigeria or closed down, when Michelin relocated to Ghana, they did not do so because banks did not have capacity to lend money to them. Banks had capacity to lend money to them. But the business, the macro environment,
like you talked about,
drove them out of the country. So now with things like the economic recovery and growth plan and interventions like this, like interventions in agri sector, the 220 billion fund in SME, and all of that. If the big manufacturers come alive, there are value chain opportunities for even small manufacturers to tap into. So that if you have companies operating, actually, it's easier and safer to lend to this kind of companies in manufacturing and corporate level that we're talking about.
Do you think it automatically will make the macroeconomic factors better?
Yeah, because remember the core of this whole thing is to make sure you generate. By the way, there are guidelines. It has to be something that is, it's local, like backward integration. It has to be preferably FX generating. It has to be so. Ultimately, that means you're going to hire more people to work in these factories. That means employment rate will improve. That means disposable income will improve. That means quality of life will be better for, more people, become employed. Crime, of course, will reduce. It has a chain effect. Then it makes those companies more attractive when they are in full capacity production for foreign investors, for instance, for them to even issue corporate bonds and have people subscribe.
And I mean, and that's also part of the policy, is that bonds will be backed by the CBN as well.
Yes.
Okay, and which people haven't there hasn't been a lot of conversations around the bond part. Is that because people see more opportunity in the lending part and not in the bonds? Can you just sort of shed some light on that? We haven't
bonds, I mean, no. Well, for you to issue bonds, you have to meet certain rigorous standards. Proper accounting, you have to have. So if a manufacturer today, a manufacturing company that has been comatose in the last, say, 5 years, if they come alive today on account of this intervention, over time, by the time they operate for 1, 2, 3 years, they would have, convinced bond investors to, invest in their bonds. Now, there are existing companies today that actually qualify. So it's now for those companies to then come to the market and assess this opportunity. But we're talking about this today because CRR involves direct lending. But bonds, are instruments that, investors would then invest in. So from banking perspective, we're focusing on the CRR part. And then from the corporates, they would then have to assess the market with this opportunity and issue bonds following the guidelines that CBN has.
And do you see today that there are enough companies in the manufacturing and agricultural space to take advantage of this new liquidity that is going to be in the market?
I don't know about enough, but there are companies. I mean, when you talk about enough, who defines enough? The important thing is now corporate bond issuance, the opportunity space has just improved. So the likes of the flour millers, the beverage companies, many of them can access that market, and it's longer term funds.
What has been
cheaper.
the response to this policy, this new CBN policy, by the manufacturing and the agricultural sector?
Massive. Just on Wednesday, we submitted quite a number.
A number of applications?
Yep.
Oh, wow.
And I mean, there's a particular rice mill, one of the biggest in this country, that we've been supporting when nobody would touch them. We are just about, in fact, the CBN is very serious about this, to the point where CBN is actually following up, like, what are you doing in this area? And
fantastic.
so it's not just the
So it's not something that's just been announced, it is something that is actually, you've seen the activity,
it's
the
collaborative.
traction and everything.
In our risk committee, we just compiled a list, and we're already making the moves, and very soon I'm sure most of them will begin to assess this.
Let's talk about your risk committee for a bit. So when businesses like this who want to access this loans come to you, what exactly are you looking at? Because we know what the terrain is like. When it was at double digits, it was really horrible. Now it's at single digits. A lot of people want to cash in on this kind of thing.
Remember, banks do not operate in isolation. We are heavily regulated. There are sanctions for infractions. So you must have a robust, solid risk management framework, which is what we have. I mean, you see, you couldn't just jump out and start lending. There are processes. You have to go through certain analysis from unit level to divisional level to management credit committee level, and then board credit committee level, depending on the amount. All of these are checks and balances. And the regulator would also play a role in making sure that you do not take excessive risk. That's why they have bank examiners come to inspect you once a year, or twice a year, depending on your composite risk rating.
One of the risks that the gentleman, our guest 2 weeks ago, brought up was leakages also in the system, which was, they were referring to people that might not be traditionally in this sector coming in and taking advantage of this. Is that one of the risks that you see happening, or do you think that that is one of those things that is unfound?
I heard him talk about that, but he's absolutely right that every time an intervention like this happens, Nigerians have this sense that it's national cake you're sharing. And that's why you would approach a bank. I mean, you know nothing about agriculture. So you hear that somebody who has a 1 hectare farm makes 1 million profit. So you go and acquire 10 hectares and approach the bank because in your head you're already seeing 10 million profit without considering the inherent risk or, you know, understanding the business. So that's where we come in. You're not going to cross that hurdle if you do not meet the criteria. And that's where the regulator comes in. If you read that document, it's a 6-page document. The roles of the regulator clearly spelled out. The roles of the borrower clearly spelled out. The roles of the banker clearly spelled out. If you breach any of those, there'll be sanctions. If you do not meet those from the borrower's perspective, you cannot get the loan. And that's, again, what brings us to risk management framework. Even I, as a CEO, cannot sit down and say, okay, approved. If I do, my chief risk officer will tell me, okay, we cannot do this, but if you insist, put it in writing that you're giving me override.
And then you take the fall
And
for
I don't want to, you know, get sanctioned. So, yes, we're capacitized and ready for that. Now, leakages, everything that has to do with, people think it's government intervention, so everybody wants to take the monies and not do it. So, but this time around, for these funds, would, you know, use our risk management framework to police them.
You know, this brings us to the SME focus of Fidelity Bank for a bit, because this is SME, but this is with the government intervention. Without the government intervention, we've seen how loans have gone in the past, how banks are very careful as who to lend to. Tell us what your SME focus is.
Well, SMEs, small, medium enterprises, is a major focus for Fidelity Bank. And it started at some point about 7 years ago. We decided to look at SMEs from a different perspective. We have general SMEs, and then we have managed SMEs. Now, we have a division headed by a general manager that looks at managed SMEs. What do we mean? We help SMEs build capacity, give them access to markets, and also you know, educate them, help prepare them for qualification to borrow. So we have an office where you could walk in and they look at your business and help you with tools like simple bookkeeping and so on. And over the years, we have seen massive growth in our SME numbers, and our SME loan default rate has been very low because of this approach. We did
and
not...
those SME loans are all, what rate are those SME loans usually at?
Well, they are commercial rates, but you see, the problem of SMEs is not necessarily just the rates. But I mean, a lot of, who is an SME? If today I'm not working, I'm an entrepreneur, I could start a small business along this street. But then if I do not have the capacity to manage businesses, if I don't understand basic bookkeeping and things like that, the mortality rate of SMEs are very high, and that's where Fidelity comes in to help them know those things you need to do upfront so that your business, I mean, if you look at Admiralty Way, Adiola Odeku, if you look at when the mall opened in Lekki, every person took a shop there. Go there, a lot of these people, the businesses have died and new people take up those spaces. It's because of this kind of lack of capacity. And that's why further in our SME play, we've taken it beyond Fidelity. We've partnered with Enterprise Development Center of Lagos Business School to collaborate and develop SMEs. We've partnered with Nigerian Export Promotion Council and Lagos Business School again. Next 2 weeks or so, we'll be commencing our 7th stream of export development program
for SMEs.
Where we train, we train SMEs in collaboration with Lagos Business School and Nigerian Export Promotion Council. We have testimonies of people who have gone through this program.
So the SMEs are responding?
They are responding, and that's why. Then add to that, that's why we will get stronger as an institution in SME because of what we do. It's not just about you coming in to borrow. We build capacity, we support you, we develop. And that's why also the 220 billion SME fund, we assessed 2.6 billion of those. We've got repayments now of about 1.2 billion. Our non-performing loan ratio in that area is far, far, far below the threshold of 5%. If we did not prepare these people. If you've been following the news, we celebrated some of them, some even water manufacturers in different places, in Ondo, in Kano, in Aba, in Onitsha, all across the country. So SME is something we're very passionate about, and people have mocked us to say you will lose money. 7 years on, our non-performing loan ratios for SMEs is not anywhere worrisome.
As you look at the financial landscape, and I mean, you've taken a special interest in SMEs because that has to be part of your strategy. You have to sort of all have a niche of which industries are you supporting or which sectors of businesses you're supporting. As a bank, what is your retail strategy, and how have you seen that retail strategy over the last 7 years change?
Retail, that's another light bulb in our bank. In the last in 2013, just before I became CEO, we had to look at our strategies, and we decided that our retail play would be supported by very strong digital strategy. Because if you're going to do retail and you're still thinking about brick and mortar, it will not work. So we had to use technology to drive retail. I'll give you some statistics. Today, we have 4,306 POS machines in deployment. We have 778 ATMs. We have 2 million cards issued. We have 1.5 million mobile subscribers. In 2013, we only had 54,000 mobile subscribers. Today, we have 1.5 million.
And what type of transactions, like how many transactions are you doing on mobile? What percentage of all your transactions?
Well, today, what we call digital migration. If you come, by the way, in the past, we used to probably build about 15 to 20 branches a year. Now, we do just about 3 branches or 2 a year because of digitization. So, to answer your question, what type of... the volume. What we call digital migration. And that means of all the payouts you make, of all the payments you make, what percentage are done in your brick and mortar, the branches, and what percentage are done through digital channels. Today, we're at 80% transactions driven by technology outside the banks.
80%?
Yes, and that's why if you go to our banking halls today, they are not as busy. I'll tell you a story. I walked in one morning, I came to work. Usually, I do management by wandering around sometimes, So I walked into a banking hall, and I'm like, it's 8:15, where are all these people? And they said, oh, there are no more here. Like, what happened? Oh, we don't need them anymore. Funds transfer officers, you walk into a bank in the past, you write, please transfer. You do that on your mobile phone. So we've redeployed some of these people, retrained them, and we're using them in different parts of the bank. So rather than lose their jobs, our business is growing, so you retrain them. So that's what happens when you digitize.
So with digital migration and with the increased number, I mean, you're doing 80% of your transactions are now enabled by technology, new technologies, which is in the last 5 years, 80% of your transactions have shifted. When you look at the staff that you've trained and the capacity you've built in-house, where are some of the areas that you still feel that you now have to respond to in this digital age? Because it is different skills.
Another thing we've done, we've created something called Digital Lab. We hired 28 young people between the ages of 21 and 24. Send them to training for about 2 months. Now, we've quartered them down this your road here, on Awolowo Road.
Yes.
What are they supposed to do? We just gave them the wing to fly, come up with ideas. These are people that develop apps. We taught them our strategy as a bank. They understand what we're doing. So creativity coming from those young people, we're using that to strengthen our digital play. They're developing apps. We recently launched one. When you're chatting, if I'm chatting with, say, my son, and he needs, maybe I need to send him money. While still chatting, I don't exit. I just touch the Fidelity logo on that keypad, and it brings up a menu, and I transfer funds to him.
Very interesting.
So, I can go on and on, but it's something that excites me.
But they're telling us to wrap up, but I don't want to wrap up until I ask you this question, which is around the approach and how the bank is looking at fintech. Last week, we had a gentleman here. They had just raised $8 million for their payment gateway. How is the bank looking at fintech, and how are you collaborating? How are you looking at regulation? How is fintech being integrated into traditional banking today?
Okay, well, given all that I've talked about today about digitization, if you ignore fintechs, you do so at your peril. So banks should rather collaborate with them at this point, because from what I'm describing now, I don't know who made that quote, but I agree with him when he says that banking will always be needed, but that banks will not always be needed. So what that means is that people are going to do banking,
yes,
but not necessarily in brick and mortar as banks.
Yes.
So what we have done, these boys I talked about, these young people I talked about,
young boys and girls.
Girls. That's what I say. Young people. I don't want to be in trouble.
Yes,
sir. So those are the guys the kind of people that will develop all the apps and things you need. So rather than have them sitting in one room using their knowledge to do internet fraud, we're giving them employment. We're giving them wings to fly. So we're collaborating with fintechs to make sure that we provide banking services.
And what do you see as a challenge from a regulatory perspective when it comes to fintech and also that integration?
Banks are heavily regulated. Fintech, anybody can be fintech company. So you're doing banking and you're not regulated by central bank. So a major imperative to protect all of us from cyber fraud and things like that is to also develop a very solid framework for fintechs. No problem, you can do financial services, but you should subject yourself to regulation.
Almost tier 2 banks in the country, Fidelity Bank. Thank you.
Thank you for having me.
Thank you so much for being here.
Thank you.